Good morning. Welcome to Trading Hour. It just feels like Friday the 13th is playing out for our markets now. Sharply lower on the benchmark indices, 1% gone, more than 1% gone on the Nifty and the Sensex. Important support levels of 24,400 to 24,500 have been breached in the sell-off today. Broader markets are not spared. Look at the advance decline ratio, Sonal. One stock advancing for 5 in the red, and there's literally no sector which has been spared.
All of them in the red today. And, you know, you speak about the broader markets. We were talking about how small caps and mid caps, they have been doing really well this month so far. But now there's a definite profit booking. The lines for advances versus declines, they're just seeing a broader a gap between them by the minute. Nifty Metals Index, that's, of course, the top loser, 2.5% gone there. Nigel just spoke about the factors which led to that as well. PSU Banking Index has come in for profit booking. Realty Index, that has been surging off late, is also down 2.5%. So a lot happening in the markets as well. There's a wee bit of a recovery. We went below the 24,200 mark as well, but now above that mark. So a lot's happening in the market. So it's a good time to get in some market opinion. So let's invite Rohit Srivastav, the founder and strategist at IndiaCharts.com. He's with us in the studio. And what a day to have this conversation, Rohit. Thank you so much for joining in. It's a sharp fall that we are seeing today. First up, what are your thoughts on the markets now? You think this could continue and December would not be the cheerful month for markets as you usually see?
So I do think that there's a lot more downside in the months ahead. But if I actually focus only on December, we can still have things go both ways because, you know, today after this sell-off, we are at a critical support that's around, 23,184, I think around the 24,184, around the 20-day moving average. One of the indicators, one of our proprietary indicators known as the momentum swing is reading in at around 6. Now, what that really means is that there are only 6% of stocks with positive momentum in the market. So when you have such a low reading, the first thought is it going to bounce back now from here? Okay, so 24,184, we will look for some kind of a bounce. But will the bounce be meaningful enough or significant enough? Will it take us back to 25,000? That is a big question mark, right? So the next bounce is where we would sell. If somebody is looking at selling here, we would say probably wait for a bounce and let's get a better price. But overall, on a 2-month, 3-month basis, I think the markets are going to remain weak. No matter how much we bounce up, there's going to be selling pressure again, and it's likely to become a little more global. So these are the things to keep in mind.
Okay.
And why do you think the selling pressure will continue or perhaps get worse over the next 2 to 3 months? What are you reading on the global charts as well? As you said, it's going to be maybe top down in a way from global led.
Yeah, so this time, interestingly, the Indian market topped out, I think, well ahead of global markets. So I do think that the October top at 26,300 almost, I think 277, that's the exact number, is where we've fallen from there, in what we call as an impulsive decline. Now, when we say impulsive, it simply means that you will not make a new high. You will probably see retracements. And that happens when a lot of sentiment reaches an extreme. Everybody turns bullish, everybody's a buyer, and then things turn from there. I mention this because the US market over the last 2 weeks has now those kind of readings. Like I have received, a dozen or 2 dozen charts from various, authors showing that sentiment in terms of the number of people who are invested, the amount of cash with retail investors, etc. Various such numbers have all, reached levels which are way above historical peaks. So that means everybody is all in invested. Now, if you just look at the last 1 week, we saw the Dow Jones fall for 6 to 7 consecutive days. The Nasdaq was still making a new high till yesterday, so it's a bit early to say whether the Nasdaq is also done and going to join in. But I think the sentiment data is telling us that everybody has become over-optimistic post the US election and the rate cuts that started. And that over-optimism now needs to cool off, and which is why I think going into the new year, very similar to what we saw in 2022, you often get a peak just around the December-January period, which is the year end, where a lot of, extra cash gets allocated into funds, and then you start the new year, on a clean book, and then it sells off. I think that's the setup we are really seeing. And that's why I think the global market may also surprise us on the downside. And our market has already been weak, and which is why every bounce, any negative comes in, it sells off much harder. You can see that in individual stocks as well. In fact, one stock which probably I highlighted some time back also on the show is Reliance Industries, right? So Reliance Industries had one of the largest short positions when we discussed it 2 weeks ago. And yesterday, after its recent bounce, where it couldn't even get past, say, the 40-day average, it has fallen, and yesterday on the close, the short position was at again a new high. And I'm saying short, which is an interpretation because we don't get the long short breakup. But the interpretation is based on the open interest rising when prices are falling. So when prices are falling and OI is rising, we are interpreting that, okay, the OI is essentially building up shorts. And yesterday, the OI hit a new all-time, I wouldn't say all-time, but the highest since 2006. So that's like almost... how many years? 18 years or something like that. And 2006 is when you got that big crash in May of 2006 when markets fell 30%. So that's the last time RIL had a big short position. Then, of course, it did bottom out and reverse. But yesterday, we didn't see that happen. We haven't seen the OI come down. And that's when you would say, okay, shorts are starting to get covered. You probably need some good news around Reliance for that to happen. So if that happens, that could be a trigger for a bounce. But right now, it hasn't really shown up.
Yeah, their O2C business has been seeing some weakness, and that's like the majority part in terms of, it's the cash cow of the business as well. But you said that barring December, things are not looking so good for the market. So which are some of the sectors which would contribute to that fall that you're expecting in the markets to continue?
So this has been pretty broad-based. I think the places where there was some hope, one was banking. Especially private banks, because they'd become extremely undervalued. And the second has been the IT sector, again on the back of the US market, so which is why that will still remain a watch point, because the Nasdaq, while it was down yesterday, has still not given a clear trend reversal like the Dow or S&P. So can we still have some upside on the back of IT? Question mark. That may be a possible safe space. But apart from that, most other sectors we are not seeing significant retracements or new highs, and I think wherever bounces have happened, they are getting sold into. So we don't really see strength in general. I think the one index which really stood out has been the small cap index, right, which actually closed at an all-time high right away. But last 2 days of selling almost makes it look like maybe it's done. I'll still, again, small cap index, I'll again give it room next week and see that it can make one more move to the upside. But we are late in this rally now, as far as the small cap index is concerned. In fact, I can make a comparison with what happened in 2021. The Nifty topped out in end of October 2021, and 22 January, the small cap index made a new all-time high, and the Nifty did not. Same thing we are seeing here. Only you shift the time frame 1 month behind. That this time we topped out end of September, and in December we are seeing an all-time high with the small cap index. So I think, if that is the same divergence and it remains, you don't see a new high in Nifty with the new high in small caps. Usually this kind of an intermarket divergence is technically seen as a negative. And then it eventually plays out in a trend reversal to the downside.
Okay. Rohit, just one final question then. You were telling me in the break that you've been negative in the market since October. Now, the sell-off started because of, fundamental reason, the corporate earnings not being up to expectations, government capex. Technically, what is it that you saw in October that made you so bearish on the market? And how this call that you're taking, that things are going to remain weak, is this safe for the next 2 to 3 months, January, February, March? Will budget? I mean, give us some time horizon.
Yeah. So up to March is the easy call. Okay, that, the setup is there that we head down to March, probably retest previous lows, 22,000, 21,000 maybe. And what we saw in October is the end of, one extreme in terms of sentiment. What I would look there is...
impulse sentiment.
Not only that. So when we measure sentiment, we like to look at data also. So if you look at FIA positioning in the index futures, it had reached near all-time highs, or as high as last time in 2016, which is around demonetization. Right, so that's again a long period. After 9 years, you had the highest long position held by FIs in index futures. And that's a sign that, excessive bullishness had, come into the market. And that was one of the signatures. So when we got a technical sell signal and we look at that data point, then we say, yeah, this probably needs to go down a lot more to unwind all that position that got built up.
Okay, all right. Take that point, Rohit. Thank you so much for stopping by on a day where we are seeing those massive cuts in the markets. Friday the 13th, that seems to be working out. Thank you for your thoughts today. Well, with that, we'll do one thing. We'll slip into a short break. Morgan Stanley and Jefferies, the two brokerage houses, have come out with their India strategies for 2025. We'll put the spotlight on that on the other side. Welcome back. You're still tuned into Trading Hour. Well, Morgan Stanley in their recent note says the Indian bull market is here to stay. Hormaz is joining us with the key highlights of that note. Hormaz.
We've been in a long phase of the bull market, right, with a lot of these participants in the street calling it an aging bull market. But Morgan Stanley is of the view that this aging bull market still has more legs to run ahead. Now, what the note says is that the bull market has now overtaken the 2003 to 2008 period in terms of length, although the returns of this bull market is just a third of what the market had seen in the 2003 to 2008 period. Now, the earnings cycle as well, the quarters recently have been disappointing, but they say that the earnings cycle is midway and the valuations too are not rich for our markets. Now, why can the Indian market last, the bull market last longer? According to Morgan Stanley, they're saying that the private investment cycle is picking up and that can extend the earnings cycle, which will further make valuations attractive going forward. The domestic inflows that have supported the markets all these months, it's not likely to fade away anytime soon as well. What they also say is that there are prospects of more free trade agreements, rupee trade, and that will further add a boost to the growth estimates as well. The per capita energy consumption, according to Morgan Stanley, is likely to increase in the next decade, and they see an upside to both earnings as well as valuations going forward. So in this regard, what you should own and shouldn't own, Morgan Stanley believes that you should own financials, consumer cyclicals and industrial cyclicals in the next leg of this bull market, and what you shouldn't own includes the likes of staples, utilities, healthcare and telecom. So these are some of the sectors that Morgan Stanley is a little cautious on, but is betting on financials, consumer cyclicals and industrial cyclicals.
Okay, and Jefferies too has come out with the India strategy note for 2025. Hormuz, what does that say?
It's a slightly cautious tone compared to Morgan Stanley, although Jefferies too sees an upside for the Nifty going ahead. Its 2025 target for the index is now 26,600, which is slightly above the 26,275 odd that we had made in recent times. What they say is that the 1 year forward Nifty price to earnings multiple is now trading above its 5-year average, and as a result of which it is expecting only 10% returns in 2025, which is in line with the earnings growth estimates. And considering the fact that it has a cautious outlook for the market, it is bullish on large caps over other broader market names within the mid caps and the small cap space. Now, what they say is that the investment cycle is currently in the 5th year, and they are expecting another 5 more years of this to continue. The housing cycles too continues to remain strong. The housing inventories are at a 14-year low, which is why real estate is one of their sectoral picks. We'll get to that in just a bit. The private capex is on the rise. There are opportunities emerging in power, electrification, PLI schemes, building materials and such sectors as well. And it is this capex uptick that is likely to support this 6.5% to 7% GDP growth that we are likely to witness in 2025. So what is Jefferies overweight on? They're overweight on multiple sectors, right? They include bullish financials, IT, telecom, auto, healthcare, power utilities and real estate, as I just mentioned, and they are underweight on sectors like energy, staples, the consumer discretionaries excluding auto, materials, and they're neutral on the industrial segment. Now, what they also say is that this domestic supply of funds that is likely to remain strong. The IPO market will remain heated as it has been this year as well, and this supply of paper will remain elevated until the market corrects and there is a change in sentiment. Now, it has highlighted 9 names which are among its top picks, include the likes of ICICI Bank, Axis Bank, SBI, Coal India, Bharti Airtel, and most of these names have potential upsides ranging anywhere between 20 to 40%, but for the index, it has a slightly cautious tone.
Thank you. Bottom-up market. That's the outlook for 2025. We'll slip into a very short break. We'll come back and talk market technicals. Mitesh Thakkar will join in with his top trading bets.
Welcome back. You're still tuned into Trading Hour. Well, banks like IndusInd Bank, Axis Bank, AU Small Finance Bank, all of these stocks are in focus on the back of a brokerage report coming in from UBS. Abhishek Kothari is here with more details.
Well, UBS has written on lenders, both banks and NBFCs as well. They say that NPL risk have increased for CV lenders and business loans as well. So CNBC-TV18 had highlighted that CV financiers are seeing dual pain of lower loan growth as well as, asset quality deteriorating for them in November of 2024. Early delinquencies for the commercial vehicle finance rose by 150 basis points in the month of October when compared to the month of March 24. And they say that this is led by mid-sized private banks and NBFCs as well. While business loan, that also saw an increase of 70 basis points in early delinquencies. So moreover, the static pool analysis that they have done of disbursements in recent quarters to suggest that there is deterioration in the portfolio quality of all the lenders. So they maintain their view on rising NPLs and they raise their credit cost estimate anywhere between 2 to 25 basis points across lenders. On individual stocks, UBS has written IndusInd Bank with a neutral rating and the target price has been slashed by 200 rupees per share to 1150 from 1350 that they had earlier. They cut the EPS estimate anywhere between 5% to 6% over the next two fiscals. Axis Bank, they have a neutral rating. Target price has been cut by 40 rupees per share to 1,210 from 1,250 that they had earlier. And for AU Small Finance Bank, they have a neutral rating and target price has been cut by 110 rupees per share to 640 per share from 750 that they had earlier. Their top picks are SDFC Bank, ICICI Bank and Federal Bank. Amongst NBFCs, they say that there is increase in credit cost estimate for them for FY25 and 26 by 1 to 20 basis point for Bajaj Finance, Chola, Shriram as well as Mahindra Finance, and hence they cut the next two fiscals, that is FY25 and 26 estimate anywhere between 1% to 7%. Back to you.
Thank you very much for that. By the way, some recovery in the market. So the Nifty, after breaching 24,200, has now climbed above 24,300, so a recovery of more than 100 points. There you have it. Mitesh is now back with us for a quick technical check on the markets. Mitesh, you were telling us the important support levels were 24,350, 24,400. Now that's been convincingly broken, though we are attempting a bit of a pullback. What's the trade now?
So I think, one, I'll wait for today's closing, and if the closing is below 24,350, good chance that we'll see a test of 24,000 or maybe levels below that. So, slightly the setup with closing below 24,350 turns negative, and that's the level to keep an eye upon as the day and the week comes to an end. As I said, I think closing below will significantly weaken the hourly to hourly charts, which means that more damage could happen in the near term.
Okay, all right. So that's the levels on the Nifty to watch out for. What about individual names, Mitesh?
Yeah, so I have a sell on Godrej Properties. That's a sell with a stop at about 28.30 odd levels. Look for targets of 27.40, maybe slightly lower. And on the buying side is HCL Tech. The technology index is still outperforming the broader markets and is doing better. So on declines, HCL Tech has corrected from 1950 to about 1910 levels. So buy here with a stop below 1910 and look for a target of around 1975 on the upside.
Okay, thank you. Thank you very much for that. We'll touch base soon enough, get into a short break. On the other side, we'll get you key excerpts from our exclusive conversation with KV Kamath. Stay tuned. Welcome back. In an exclusive conversation, Shireen Bhan quizzed KV Kamath on regulations in the banking and financial sector to keep pace with innovation. She also asked him his views on allowing corporates into the banking sector. Listen in.
speaking about regulation and regulation keeping pace with innovation, and specifically as far as the banking sector is concerned, two questions, sir, as we look at the next 25 years. Do you believe that regulation should allow a fintech, for instance, to be able to get a banking license? I mean, the founders of Zerodha in their conversation with me said, we want to be a bank. If we could apply for a banking license, we would do it, tomorrow. Do you believe that that should be something that we consider as we go forward? And two, allowing corporates into the banking sector. This has been much debated, much talked about, much asked for as well. Do you believe that the time has come to perhaps consider that possibility?
See, we need to understand this whole question from the perspective of the regulator. A regulator, primary purpose on the banking front is safety of deposits. So when the regulator feels that there is comfort in fintech or digitech coming in and becoming a bank and taking deposits, for which finally the Reserve Bank or the regulator is going to be responsible for, at that point of time they will allow this to happen. So clearly it's a transitionary process. So as that confidence builds up, that change will happen.
So what does your gut tell you? I mean, if you were to take that call today,
yeah, I think,
on the back of what you're
to
seeing?
be very frank, it needs a little more time, because I am seeing signs of rash behavior. I'm being very frank about it on the part of digitally driven enterprises, which I think the regulator has had to manage with great care. If you look at it as a bank, as a banker, if a regulator says that on, say, retail unsecured lending, I have to increase risk weightage by 25 bips, to me it is a signal. Or if another regulator says that 90-95% of F&O transactions are basically where people have lost money, and maybe 60 entities on the other side have made money, and that this funding has come from where? It has come from somewhere within the financial system. And I think they are not amber flags. They are red flags all over the place. So the regulator has to be careful. I think in the context of corporates, I think there is a different view that was there. These things that I mentioned will be relevant, but also is there going to be what I'd call lending to self, and how to go about it.
Yeah.
So I think the regulator has to be comfortable with these things before he proceed. But to me, the first step is bulking up of existing players.
She also, asked him if there was a need for privatization of PSU banks. Listen in.
Is there room for privatization of banks over the next 25 years? Do you believe that there is political will or political capital, even though we've got the legislation, in place? Do you believe that there is political will or political capital?
I don't want to go down the route at all. What I'll say is, if public sector banks are going to run an ROE of 15 to 20%, they should thrive. So why should there be a need to privatize them? Give them more freedom, but make sure that your ROE is 15 to 20%. To me, that is the holy grail.
And you can catch excerpts of this interesting conversation all through the day only on CNBC TV18. Get into a break on that note. We'll come back and talk more about the markets. Manish Jain of Centrum joins in on the other side. Welcome back. It's now close to about an 8% plus correction that we've seen on our markets from a recent high. We corrected over October and November, but over the last 6 days, markets were consolidating. Today, there has been a big leg down, but markets are trying to recover. Where do we go from here? Manish Jain from Centrum is now with us to discuss the market fundamentals and his top ideas. Manish, what have you made of the action that we've seen? December is usually a good month where Santa comes. Historically, December has given about a 2.5% kind of return. So far, there hasn't been any sign of that. What are your conversations with investors like? You're in
Sorry
mute.
for that, yeah.
No. Go ahead.
So I think it will take about a couple of more months for the market to kind of recover from here onwards. I think this is something that we've been maintaining for over a month now, that at least till the end of January, when we are like halfway through into the Q3 results season, the market is going to be fairly range bound. We are looking at 23,500 to 24,500, 24,700 as a broader range in which the market is going to continue to trade. Largely because if you look at the last couple of months, more bad news has come in as compared to the good news, right? I mean, the government capex has been much slower than what the run rate, was budgeted at the beginning of the year. The second quarter result season has been abysmal for most of the headline industries and sectors. Urban consumption has been slowing down. So there have been a number of concerns which have all converged at the same time, which is leading to this kind of a temporary pullback in the market. And I don't necessarily think it's the bad news, because given the kind of rally we've seen in the last 15, 17 months, I think sometimes a little bit of a breather, a little bit of a pause is actually good news. So I think it's not all unexpected in that certain sense.
Okay. Manish, I wanted to discuss the oil marketing companies and the sector as a whole, because they saw a sharp fall. The second quarter was very weak, but refining margins are now improving. Do you think there could be some interest in select pockets like oil marketing companies while the markets overall could remain range bound?
Yeah, so our view has been very simple, that this is an opportunity. This whole correction that you see in the market is actually an opportunity to build positions from a bottom-up perspective. We are now going through a second round of sector rotation, which is underway as we are speaking, right? So you've already seen the kind of interest in FMCG that you saw in the first half of the year. It's kind of waning away now. So that is one space that has kind of lost interest. Pharma is another sector which kind of trading at peak valuation. There's a separate bull run which is going on in pharma, which is very contrary to the market. IT again has seen a significant amount of rally, but then again, I'm going to be a little more cautious in that space while building up positions right now. So in my view, what is probably going to happen is that you will see a revival of sorts in terms of the demand in the small cap space. I think that is one part where I would expect a lot of fresh investments to build up position. And in terms of sectorally, I would say power, utilities, then again, oil and gas, defense, infra, hospitals, hospitality, real estate. These are going to be the sectors where we are going to be a little more bullish on as compared to the frontline ones, which is basically, banks or maybe even IT or pharma.
Why not IT? There seems to be a fair amount of consensus bullishness coming through on IT. Do you think the good news is in the price?
To a certain extent, yes. And there is a certain bit of a risk factor that I don't think anybody is factoring in at this moment, which is that if Trump comes back into power, he may not be able to do too much as far as actionality is concerned, but his views on immigration and visa and all these issues is fairly strong. So as and when that noise picks up closer to his swearing in, there could be a bit of a sentimental impact that is going to come through as far as IT sector is concerned, and that's something that is very similar to what we had seen at the beginning of his reign in the 2016-2020 era as well. So it's not very dissimilar. So you should expect some bit of a sentimental impact in IT coming through because of the regime change that is happening in the US. So purely from that perspective.
Okay. All right. So that is about the IT space. We spoke about the oil marketing companies as well. Do you look at chemical space closely, Manish? Because that space was buzzing in 2022, but come 2023, we saw that massive cuts in earnings, a very weak commentary as well. Do you think 2025 could be the year for the chemical space?
Well, at least we are building up positions over there, specifically in agrochem space, where I think there can be a fair bit of a run-up which may happen in 2025. So we've been selectively building up positions over there as well. So definitely, I think the sector as such seems to have bottomed out. The sentiment seems to have bottomed out. It seems like a good time to buy. See, remember, as a retail investor, the best way to make money in markets is very simple, which is swim against the tide. Buy when everybody's selling and sell when everybody's buying. It's as simple as that. So buying IT right now would probably not be the best of the ideas, but a beaten down sector, like, for example, chemicals or agrochemicals selectively might actually be a great idea.
We just had one guest who was telling us that, he's taking a contra bet on metals for 2025. And his rationale was that the profitability of all metal companies is as low as it was, as a percentage of the overall profits, is as low as it was in 2001. And it's very under-owned, under-representative. So do you think metals as a contra bet could, be attractive for next year?
So that's something that we've already made a little bit of money on. In the last couple of months, we started building up position over there in our flagship scheme, Good to Great, about a couple of months back. Not exactly frontline metal, but more of a converter. And we've already made a decent amount of money over there, and we're still holding on to that. So yeah, I would agree.
And time to add on to platform companies, or do you think, again, the good news is in the price? Because 2024 belonged to the kind of returns that we've seen in many of these new age tech companies, and they've also justified it by turning profitable.
Yeah. No, you're absolutely right. See, India as a whole is changing. And as an investor, your mindset also kind of needs to change a little bit along with that. You can't keep looking at old economy stocks like, for example, cement or FMCG or retail or even metals, and then try and judge the new economy businesses with that old yardstick. It doesn't work like that, right? For example, when you look at an FMCG company or a tech platform company, they were not going to trade at similar valuations. There's not going to be a similar methodology. The growth trajectory is going to be different. So that's something that we've been doing both in the private as well as in the public space, in the equities part of it. And investors have made a decent amount of money over there. So the fact of the matter is these have to be looked at more from a top-down perspective. These have to be looked at more from a 10-year picture perspective. And if you're convinced that the industry is going to keep growing, for example, quick commerce, right? For example, food delivery. And if these sectors are going to continue to growing and these companies are going to be in the top 2-3, then nothing else matters. Your bottom-up analysis, your financial analysis doesn't necessarily need to be there. And you just go ahead and invest from a generational perspective, something which is going to be your legacy. So that's something we are definitely looking at. Yes.
Thank you. Thank you very much, Manish, for joining in. Look forward to one more conversation, perhaps, before the year comes to an end. But the IPO market has been red hot. And today we have a new, IPO which has opened up for subscription. That's the Diamond and Jewelry Certification Provider, International Gemological Institute. IGI. It opens its 4,225 crore IPO for subscription. The upper end of the price band is about 417. It's a Blackstone-owned company, and the company has about a 33% global market share in terms of certifying diamond-studded jewelry, and diamonds both natural and lab-grown. We had a chat with the CFO Ishwar Iyer and CEO Tema Sprinter, and they spoke about the growth that we've seen in the lab-grown diamonds, how this company has been a pioneer, and that will help the company continue to grow in the coming quarters. Listen in.
At the moment, we are growing in excess of 30% in India. For the 9-month ended, we are on 31% growth. I think the key driver of the industry today is the lab-grown segment. So that is what is really propelling the industry forward. And it's a new entrant in the industry. It's been there for the last 3-4 years. So we expect this to it's just a starting point. Because
overall, the margins have been at 66%, which has now grown to 72%. So that itself is an indicator of how the thing is going. Natural is unique, rare, and expensive. And where lab-grown is concerned, it's more affordable. We make more money from the volume aspect, and we make money from the unique aspect. So it's an overall mix.
Okay, the latest Vahan data for the electric vehicle two-wheeler sales is out. And here are the numbers. Chetak, that's owned by Bajaj, has seen a growth of close to about 27.7%. Ola is at 18.3. Sorry, that's the market share. Bajaj Chetak's December market share stands at close to about 28%. So at least in the month of December, it's leading the two-wheeler race where competition has heated up. Ola will come up for you. Ola market share stands at 18%. For TVS, it's 22%. Ather, which is also IPO bound, Ather Energy, that's at 14.5%. But what stands out is the market share increase that we're steadily seeing for Bajaj's Chetak. Bajaj's market share is now 570 basis points higher than that of TVS and a good nearly 10 percentage points higher than that of Ola Electric. So Bajaj continues to gain market share in the two-wheeler EV category. So, those are the numbers. The stocks will come up for you on your screen. I'm not reacting too much, still flat on Bajaj Auto. But at least in the two-wheeler category, where competition is picking up, the early lead was always Ola, Ather, but now incumbents are also now gaining traction. Both Bajaj Auto and TVS Motors, and Bajaj Auto is now the leader, at least as of the December market share. A little bit of a pickup in the stock price. Get into a break, more on the markets. Welcome back. It's now the recovery is gathering some momentum. It's 24,440 on the Nifty. The low today was sub 24,200, 24,180. So from that level, it's been a recovery of more than about 250 points. So the cut on the Nifty is now just about 1/3 of a percentage point. Mid-caps is still weaker. So the recovery that we're seeing is led more by the frontliners. Mid-cap index is still down nearly 1%, but it's names like M&M, HUL, ITC, Nestle. Remember, the FMCG stocks got hit earlier this week on the back of the negative commentary from GCPL, but now HUL is up 1.5%. ITC from the day's low has recovered. Nestle too is showing you a gain. Other than that, you've got strength in Maruti, Ultratech Cement, Adani Group stocks are also higher in trade, Infosys. So across the board, there is that little bit of a pickup that you are seeing in the markets, and it's now approaching 24,500. So things are changing very, very rapidly on the screen now. 59 points only lower on the Nifty. Very, very interesting. And look at that, in the last 1 minute, there was a vertical spike in the market. Till then, we were gradually inching up, but now the recovery is gathering some momentum. It's a wrap on Trading Hour. Don't go anywhere. Markets are exciting. Halftime report is up next.